How to predict the next stock market crash. It is a bold claim, but in this video, we're going to be diving through how we can correlate bond yields, how we can correlate interest rates and the current state of the market right now into building out our own bigger picture view for a potential market pullback. Not necessarily a crash, but an extended period of time where the stock market pulls back. So right now, as we can see, the market has made a great recovery from the last crash that we saw at the start of the pandemic. We saw SPY go from roughly $340 all the way down to $218 at the low, dipping down around 35%. Then after that, we have seen one of the craziest bull runs in the stock market's history, as the stock market has gone from those lows up over 110% in a matter of about a year and a half. And with the stock market move to the upside, we've also seen inflation as of late picking up. We even had some new CPI data out today, which I'll pop up on the screen, and that is only getting investors more worried about the potential longer term effects of inflation that the Fed keeps saying is transitory. And obviously it'll be cool to see what happens later on down the road. Given the current inflationary environment, if that's a word, if that's how you want to put it, what we generally see is commodities on the rise, and we're seeing that, for example, in oil prices. We see bonds down, and then eventually the lagging effect is stocks come down. Now, we see a slight lag in bonds and stocks, and I want to dive deeper now into yields and how that's a little bit different from the pricing, and then of course yields versus stocks. So generally speaking, when bond yields go down, we see stocks go up. Now, why is that the case? Well, if I'm going to put my money in, let's say I pull up bond rates right now, if I want to put my money into the US 10-year Treasury, right? And I know that right now I can get a 1.5% yield on my money in a Treasury. Awesome, that's great. That seems pretty low in my eyes. I want to do better than that, so I'm going to put my money in the stock market. That bond yield goes up and my stocks are up a lot. I might say, you know what, let me take some of my profits from the stock market and let me put that money into some of these 10-year bond yields, because I can lock in, let's say, a 1.6 or 1.7% yield, and I'm good with that. So generally speaking, we have that inverse kind of relationship going on there when it comes to treasuries and yields and the stock market. Now, what I also want to talk about is something called junk bonds. Now, it's kind of a weird term to use, but I want to pull it up and explain to you what this means and why it's useful, and then I want to dive into some of the charts so we can see how this is shaping out. But a junk bond essentially is a bond that's going to pay a higher yield, but it's higher risk. And so what you'll generally see is you'll see that companies that may be struggling will issue these bonds, and the risk here is that they may default and not be able to pay their interest payments, and you might not be able to get your principal back or your interest for your bond that you thought you were buying, and you're going to lock in a really nice rate or a really nice yield. But hey, guess what? They went under, they're struggling, and now they can't pay you. So yes, these are higher risk, but the yields are higher to kind of offset that risk. Now, we still see some fluctuations in this, and I want to pull this up right here. So this right here, as I pulled this up from Bloomberg, and what it's showing us here is it's showing the junk bond yields and how, as of the summer months, they plunged to all-time lows. That has changed just a touch here as we speak right now. So I want to dive into that next. But we see that bond yields right here, the junk bond yields, were so high, right? That was because that was in March of 2020. The springtime of 2020, what was happening? Market was crashing. We had no idea what was going on. Pandemic, everyone's sick, and it's like, oh my gosh, what are we going to do? That's the peak panic, and it has since slowed down as we kind of pushed through the summer months of 2020, and then we got into the winter months, and then eventually 2021, and they've come down sub 4% yield. So what does that mean? It's meaning that people are more encouraged to buy these because they see the potential recovery, and they feel that these companies will be able to recover and that there isn't a big threat of them not being able to pay back the interest or pay back the principal on these bonds. This is seen as a really good risk indicator for the markets in general and for stocks in general. It really gauges it. It's a great way to gauge sentiment for how people feel about investing in the recovery play or investing in a potential high growth play here, because they see the opportunity to buy up these bond yields. They see the economy moving back in a positive direction, and so they're not worried. So if they don't see recovery, or if they want to get out of junk bonds, well, where do you go? Well, you can go look for safer investments. And we say safer, right? Because of course, a lot of other places to go are not perfect. They're not the best place. They're not the safest place to put your money. but they will be seen as safer investments than, let's say, these junk bonds because of uncertainty potentially down the road. And that uncertainty now could be sparked by the potential inflation. How much do we see? Does it continue, or is it transitory? That's yet to be seen. That is the key that we're going to have to watch going forward. But I do want to point this out. For example, right here, we're talking about China in this article, and this is talking about how Chinese junk bond yields are now at a hair-raising 24% on average. Guys, go back to our junk bonds. These were up around that 10, 11, 12% during the pandemic. Now, with what's going on in China, these are pushing 24%. That's pretty wild. And so you can kind of see the uncertainty that they're expecting in China because these bond yields are so high. There's so much uncertainty right now that who knows if they'll be able to get their investment back. They'll be able to recoup those payments if you were to put your money in, let's say, a Chinese junk bond. But here's the US high effective yield. This is essentially a junk bond right here. So let's dive into this. This is the chart. So we kind of see how it pushed up. We hit up to, let's say, just shy of 12% and have been coming down since. Now, I do want to point your attention to the past couple of months, and we notice that, yes, we've dipped under 4% a couple of times, but recently in the past couple of weeks, let me actually zoom in a little bit more. In the past couple of weeks, we're noticing that we went from sub 4% on this yield, and now that yield is sitting up around 4.25, 4.35% or so, which is quite interesting. So we're seeing that these junk bonds are pushing back up. So they're coming off their bottoms. What does that mean? That potentially means that with the outlook right now, we're seeing investors getting a little more cautious and starting to look to flee towards safer investments, because if they kept piling into the junk bonds, we would continue to see that yield go down because everyone's buying it, everyone wants it, and so therefore that yield is not going to go up, it's going to go down. So you can kind of see when more people push into these bonds, we're noticing that yield becomes less impressive. When less people are in these bonds, that yield has to go up to kind of bring people back to get them to be more interested in taking on these bonds or investing in these bonds. So that's kind of the correlation we're seeing right there. One other thing to note is the reverse psychology approach. So as you notice that these are kind of bottoming out, almost like a penny stock, almost like some stocks we like to look at and trade on this channel, right? We see that this yield, this curve is kind of bottoming out. What that could mean is that, well, yes, it may signal a lot of people are interested in these high yield bonds. That's great. It also could mean the opposite in terms of a reverse psychology approach, or just the way you want to think about things. Why would I be interested in buying these right now when it seems like everyone's on board for recovery? I might want to look the other way. And it's the exact same thing when it was, everyone was panicking. When everyone was panicking about the pandemic, people started looking at these bonds and maybe they got a crazy high yield because they were able to kind of look the other way and take advantage. While no one seemingly wanted these things and the yields skyrocketed, some people took advantage of that. Yes, there's risk, but they took on that risk and they may have done quite well. Another thing to also note is interest rates. So we're looking at the federal funds rate. This is probably one of the biggest factors in terms of the stock market, how we can correlate interest rates to stocks. If we look at this and we zoom in over the past couple of months, really once we hit, March 2020, ever since then, rates have been super low. So once we start seeing this push up the federal funds rate, once this starts to push up, that could then start to sway investors out of the stock market and into other investments. Or hey, if I know I can get a higher yield, or if I can get a higher interest rate in a high interest savings account, for example, or if I can get a better rate there, boom, I'm going to take my money out of the stock market. I'm going to put some money in there, lock it in, keep my savings there. I don't have to worry about it. I know I'm going to always have that money. And kind of that's the psychology at play. There's other factors that go into it. There's other things to invest in. But generally speaking, higher rates, and you generally see stocks pull back or a little bit slower of a growth period for stocks. Rates are so low. What's the incentive? You're losing money. Savers are losers with inflation, with the CPI data. It's like you're wasting your money by just letting it sit in a savings account at this point. And now to the stock chart here. So we notice is we can actually draw some lines. I want to just do this because I always like doing some technical analysis. It's always fun to do. So if we take a look at this, here's the overall trend roughly in terms of the resistance points that we've been noticing on the stock market. We can actually draw even a little one right in here. So we kind of hit that trend line roughly at that 470 level on SPY. I can get rid of this guy and kind of show you guys a shorter term little resistance. So we hit this little level right here. We're kind of pulling back for now. But, the overall trend has been, look at this trend to the upside. It's been really, really strong, and we can't fight that as of right now. It seems like every, decent dip. And we did have a dip in, a span of time, let's say from September to mid-October, where we pulled back off all-time highs about 5.5%, 6% almost. And yeah, that was a decent dip. At the time, people were like, oh my, maybe the market's going to crash. Well, guess what? It was bought up right again. So what you want to make sure you're picturing here, broad scale, grand scheme, is factoring in that inflation, factoring in those interest rates. And if we keep seeing inflation the way it is, there's going to have to be a change in those rates. And so bigger picture view, what are people doing with those junk bonds? It's kind of a gauge of sentiment. What are we seeing across other bond yields, right? And how that plays a role into the stock market. Right now, it seems like the market doesn't care. The market is in full-on bull mode, but at some point, that may change as those other factors align for less favorable conditions for the stock market, and then we can see those pullbacks in the short term. But obviously, guys, we know how this game works. The markets are rigged to the upside. So yeah, you have these crashes. Yeah, you have these short-term moves. But if you're someone who can weather that storm, or you're someone who can buy those dips on certain companies and certain plays that you like, or just buy SPY, buy VOO, buy an S&P ETF on dips, and you'll be fine long term. Maybe you'll go through periods of time where we see pullbacks, where we see the market correct, where we see kind of consolidations, but longer term, generally speaking, this has been a great investment. Just sitting back, not doing too much, not worrying too much, and invest in the S&P. Be happy to hear you guys like always. Links and resources down below, some free stocks, Webull, Moomoo, Public, also a technical analysis trading course if you're interested in doing your own technical analysis. And on top of that, links to our other channels down below as well. And we'll see you guys in the next one. Peace.